Hello. This is a book review of One Up on Wall Street by Peter Lynch. The presentation brought to you by The Fantastic Four. Oops. Not this kind of Fantastic Four, but this Fantastic Four. IPMI, Ahmad, Derry, Ganesh, Andri, N. Netta. They'll be appearing in scene, reviewing book by doing role play, so it'll be easier for you to understand. Then, you must be wondering, who am I, right? I am Professor Roy, who will deliver the book review of One Up on Wall Street. But first, let me introduce you to the author, Peter Lynch. Lynch is a leading US stock investor who departed from an analyst. He worked for a leading investment company, Fidelity Investments, Incorporated and Fidelity Management since 1969. During his tenure, he succeeded in developing assets worth $20 million to $14 billion, including the results of trading the S&P 500 with an average return of 29% per year. Lynch is known to have the philosophy of invest in what you perceive, means only invest in things that you know, which will be elaborate in the later part of this video. Now, we have come to part where we will reviewing One Up on Wall Street book content. Introduction. The advantage of dumb money. What is actually the advantage of dumb money? I will let Fantastic Four team member to explain it to you.
Thank you, Professor Roy. I will take it from here. Hi, my name is Netta. Today I will give you explanation, what is the advantage of dumb money according to Peter Lynch. Peter Lynch in his books said, in the investing world, smart money isn't so smart, and dumb money isn't really dumb as it thinks. So, stop listening to professionals. There are 3 reasons to ignore what the professionals, or even what Peter Lynch, buying. First is, he might be wrong. A long list of losers from his own portfolio constantly remind him that so-called smart money is exceedingly dumb, about 40% of the time. Second thing, even he's right in picking stock or picking the right time to action, you will never know when he's changed his mind about stock and sold. Last thing, you've got better success, they're all around you. All you have to do is stay alerted, because you can pick spectacular performers right from your business or neighborhood long before Wall Street discovers them. I will give you an illustration. Let's say you are a frequent traveler, and there is a local airlines recommended by your friend, which you currently use to travel. The more you use this airlines, the more you like it, because of its affordable price and the decent service that you received. Furthermore, you start to realize that your friends and your colleagues start to talk about this airlines, giving good testimonials and using it quite frequent as you do. After going back home, you start to search information about this airlines, doing analysis of its performance during several years. Then you find out this local airlines share still as low as 100 rupees per share, and you decided to buy 1,000 lot. 5 years later, the local airlines, which you know from your friends and neighborhood, has become a global airlines and its shares has become 1,000 rupees per share. That means your 100 rupees has become 1,000 rupees in 5 years, 10 times from your initial investment. This is what Peter Lynch called as 10 baggers. As a summary of this section, what Peter Lynch suggests is that you are not always need to listen professionals if you want to buy stocks. Instead, start looking around you. Because potential 10 baggers can be one of your favorite boutique next door, or your favorite snacks and drinks in the supermarket. Or maybe, your reliable transportation provider can be 10 baggers. All you need to do is pay attention to research, buy the stocks, and see what happen in the next following years. Here are the examples of 10 baggers company. Look for an undervalued company with great growth potential. This is probably a small company with good financials looking to expand. But please, also remember Lynch's second principle is to do your homework, and never invest in a company without understanding its finances.
Hello. We have come to part 1, preparing to invest. My name is Ganesh from Fantastic 4, and I will take you to go through this part. Before starting the investment in individual stocks, Lynch offers 3 basic questions that need to be answered. First is, do I own a house? If you don't, buy a house first. Some might argue with this advice, but the permanence and investment qualities of a home, the advice does make a lot of sense. Question number 2. Do I need the money? Don't invest with money that will leave you feeling sick if you lose it. Use extra money. Money that won't devastate you with each loss. Question number 3. Do I have the personal qualities it takes to succeed? Lynch lists common sense, a tolerance for pain, open-mindedness, detachment, persistence, humility and the ability to ignore general panic, are the traits to be a successful investor. Notice that among these traits, a high level of intelligence is not found. Because you don't have to be a genius to succeed at investing. Another advice from Lynch is, invest in what you perceive. Means, seek the stock that is understood and believed in. You should avoid to invest in stock that you don't understand. I will give you an example. Anna is working as a doctor in hospital. And Derek is working as an oil engineer in an oil and gas company. Both of them are interested to invest in stocks. One day, Anna watched TV and found out that oil price and stock markets rise. Anna then decided to buy some oil company stocks as the information which she got from TV and internet. On the other hand, Derek is bored with the routine that he always do in the oil industry. He then decided, why don't he buy stocks from the pharmaceutical company? He thinks this industry is prospecting, as many people would always need health service. After going home, he purchases some pharmaceutical company stocks. Although what Anna and Derek has done is not totally wrong, but it is better to invest in what you already understand. Anna should invest in something that she understands, pharmaceutical and health service. While Derek should also invest in something around his industry, like oil and mining service.
Hi, my name is Emma. Now we will discussing about part 2 of Peter Lynch book, Picking Winner. In previous part, which presented by Net and Ganesh, you have all been aware that you can seek out the inspiration for companies to look into from day-to-day life. Once the company has been identified, it's time to dig in and do the research. This is what have been described as do your homework. To do your homework, it is important to understand the basic business of the company. Depending on the pace of growth, or the timing of business cycle, companies can be grouped into 6 categories: slow growers, stalwarts, fast growers, turnarounds, cyclicals and asset plays. Among this category, there are certain characteristics that you should be aware of. Characteristic in the first 3 category is by earning growth. And the last 3 category is characteristic by situation. I will give you some illustration to help you understand better. The slow growers often described as large and aging company. They started out as a fast growers company and eventually pooped out, either because they had gone as far as they could, or else they got too tired to make the most of their chance. Electric utilities are the most popular slow growers. Throughout 1950s into 1960s, utilities were fast growers. They were successful companies and great stocks, expanding at over twice the rate of GNP. In the 1970s, cost of the powers rose sharply, consumer learned to conserve electricity and utilities lose their momentum. A sign of slow growers is that it pays a regular dividend. This is why you will find not more than 2 to 4% of this stocks in Lynch's portfolio. Company like Coca-Cola, P&G and Colgate-Palmolive are the example of stalwarts. These multi-billion hulks are not exactly agile climbers, but they are faster than slow growers. Lynch has suggested to keep some stalwarts in portfolio, as they offer good protection during recession and hard times. Fast growers is a small and aggressive enterprises. It grows at 20 to 25% a year. If you choose wisely, this is the land of 10 to 200 baggers. One or two of these can make a career, although there's plenty of risk in fast growers. This is the favorite investment according to Lynch. The trick is figuring out when they'll stop growing and how much to pay the growth. Moving on to the company which have the characteristic based on special condition. In cyclical company, sales and profit rise and fall regularly, in an almost predictable fashion. Timing is everything in cyclicals. You have to be able to detect the early sign whether the business is falling off or picking up. The example of cyclicals is steel company, or automotive company, where in general, they follow the overall pattern of the economy. If you are working in some profession that have similar pattern to cyclicals companies, then you should consider to invest in this kind of investment. Turnarounds company is a no-growers company that are depressed and often close to bankruptcy. You can make greatest profit from its revival once the price is rebounded. Tips: if you are investing in turnarounds company, do not follow general market, as they are least related. An asset plays is any company that's sitting on something valuable that you know, but Wall Street crowd has overlooked. The undervalued asset are oftenly made up of real estate. Common example is a company with real estate that was bought a long time ago. That's now worth a whole lot more than when it was bought. The asset plays is where the local edge can be used to the greatest advantage.
Hi, my name is Andre and this is my turn to explain part number 3 of the Peter Lynch book, Long-Term View. This final section discusses assembling a portfolio to maximize gain and minimize risk, knowing when to sell and when to buy, what to do when the market collapses. I will explain to you some of the best tips that are pulled out of this section on how to do and how to cope with the condition mentioned earlier. Tips number 1. Sell the second that your reason to own the company changes, but not a second before. Don't just sell to take gains. You should know exactly what your reason for ownership is, and know what exactly constitutes a change in that reason. If you own because of the owners, sell when the ownership changes, for example. Tips number 2. Buy when everyone else is selling, for instance when the market down. This just means that the market decided to put stocks on sale. Take advantage of that sale. Tips number 3. Be patient. As long as your fundamental reasons for investing don't change, don't get impatient. Sit on that stock. Sometimes it takes years for a stock to truly take off. Don't just blindly follow the numbers. You shouldn't just buy because a stock seems cheap. You should believe in the company with sound reasons backing up that belief. To sum up, this section tells us to not invest in a company, unless you have a compelling reason to invest, and believe in that reason.
Hi, my name is Ahmad.
And my name is Derry.
Now we will be presenting our group opinion about One Up on Wall Street book, by Peter Lynch. I will start describing about some points that our group agreed. First of all, in this book, Lynch doesn't consider himself to be some kind of genius. Because of that, stock picking method, mentioned in this book, is convincing enough for the beginner investor to follow. Also, he elaborate with his own experience. He likes simply walking around stores to pick up investment ideas, get the 10 baggers and do the homework before pick the right stocks. Last thing, some of Lynch's other advice is more straightforward. He argues that investors should avoid complexity and invest in companies they can understand. In addition, he points out that being able to invest in smaller, lesser-known stocks is a big advantage for individual investors.
Moving on to the some point that we, as a group, would like to criticize about this book. First, Lynch too underestimates analyst report. He prefers not to choose big major player stock. This is very risk-taking, although it also has bigger winning probability. Second, the book is too narrow and underweighting crucial investment concepts like valuation and investor psychology. Third, although Lynch is very open about his investment selection process, and what he looks at when studying balance sheets. We could not find any practical value out of this book. Last but not least, Lynch doesn't mention his position of sizing strategy or his exits from the stocks he owns. This would certainly have been helpful for the investors or traders. In general, it is a great book, and our group would recommend it to anyone interested in investing as it is easy to read, especially it's a good start for beginner investor.
Thank you Fantastic Four, for presenting One Up on Wall Street book review. So now, you understand the investing perspective from Peter Lynch, right? So, Ahmad, what's the definition of wealthy?